Let's talk to Ben Kumar. He is an investment manager at Seven Investment Management. Very good morning to you, young Ben.
Good morning.
Right, what's going on in the world?
Well, what is going on in the world? Everyone has suddenly remembered that equity markets can go down quite sharply as well as go up. It's probably, 8 months really? We saw it in February, end of January, February this year. People suddenly woke up and realised that markets can go down. And I think we're seeing something similar now, because the amount of explanations that people have given for why the market has fallen tells me that no one really has a clue. Is it interest rates? Is it something to do with China? Is it something to do with Trump? Is it something to do with Brexit? Is it something to do with the Italian elections? There's a lot of reasons out there.
Yep.
And it just tells me that people are looking around going, I don't really know why this happened. I'm being forced to put a reason on it. But actually, I think most people are sitting back and going, this thing does happen from time to time. You do see markets fall. It is normal. We've just forgotten that over maybe the past 2 or 3 years.
But let's assume that we're in sort of the 9th innings and we're at the top of the market there or thereabouts. You do get increased volatility, right?
You do, and you get increased volatility towards the end of any kind of economic or business cycle. The difference, though, is whether you're at kind of the top of the 9th and you've got the whole 9th innings, which can go on for a really, really long time.
Yep.
And towards the end of the economic cycle is when you actually see some of the best returns in the equity market, particularly outside of the US. So, people who are saying, oh, this is the end, if it's not the end, you stand a decent chance of missing out on what could be the returns that really, really help portfolios grow over time. That's the problem with saying, oh, but this is the end every time. People miss out on staying invested over the long term. And that obviously is what you should be doing, but it does get really, really hard, I know, when headlines are screaming, it's the end of the world in equity markets, here we go again.
But the FTSE 100, I remember one of your learned colleagues said that, it's effectively a trading range, 7,000 plays 7,700. Yeah. You sell it at the top, you buy it at the bottom. Is this a good buying opportunity, do you think?
I actually said something like that today. I said, look, should you be thinking about buying here? We're talking about opportunities, what's come up, where should we be looking to put money in? People are swayed by big round numbers, and if the FTSE 100 goes under 7,000, a lot of people out there will go, yeah, I should probably be buying that, despite the fact that only a couple of years ago they thought it would never get over 7,000.
Yep.
People who trade the market on a looking for opportunities, they see things like that and they think, you know what, that makes it worth buying. And that we know that money is what moves markets in the end, not the narrative that you put on it after the fact. If you can be where the money is, slightly ahead of the big weight of money, you'll end up.
But in terms of the valuations, the FTSE is now cheap, isn't it?
It's incredibly cheap. I mean, if you think as well, the FTSE is now higher than it was when oil was heading for $25 a barrel. And yet oil is at $81 a barrel this morning, right? You've got two of the biggest companies in the FTSE basically get oil out of the ground and sell it for money. You've got to be thinking, why is the market down so much when things are so much better than they were? The FTSE 100 has a lot of other good companies that are better, I think, than they've been in a long time. The banks in the UK, for one, they're not exciting. They're not out there being the biggest bank in the world like RBS was, but they just get on and make a little bit of money, and interest rates are rising, which helps them. So, the FTSE 100 does start to look quite interesting.
And in terms of just finally, alternative assets, okay, is there anything in the alternative asset world that's screaming to you as a raging buy at the moment, if you did want to do some sort of hedge?
Well, I mean, the problem with alternative assets is that it's a great marketing label for people to come in and go, oh, I've got something that's alternative, and people go, oh, brilliant, it's not equities and it's not bonds. Actually, if you look at quite a lot of alternative assets, they are just equity or bonds. They're packaged up a bit differently, right? But really, if there is a big market fall, they tend to move down with it. I think a lot about the short volatility strategies, right? In a normal market, selling volatility means you go up and to the right in a nice straight line till volatility happens, and then you go down really, really sharply like the rest of the equity market. Lots of people got carried out by that trade in February of this year. You're probably going to see a few people screaming again now because they've done the same thing.
Yeah.
So you need to know what alternatives you're buying. You need to understand the risk you're taking, because you don't get paid for nothing. You will be taking a risk somewhere in your portfolio if you buy an alternative strategy. You just need to work out what it is and see whether you want to take it.
Ben, on that note, thank you very much indeed. That's Ben Kumar from Seven Investment Management.